And on Monday, we've been looking at an endowment insurance, which was issued to a 50-year-old with a duration of 20 years. And we've been looking at the policy value at a time point t for this particular endowment insurance product. Premiums were payable throughout the term of the contract. So that means that the premiums are payable for 20 years, right? Level premiums, level annual premiums. And on Monday, we already said, okay, if you put yourself at time t, if you put yourself at time t and you look at the policy value on this contract at time t, not sure what's going on here, but if you put yourself at time t, then we can express our policy value as follows. This is the sum insured. If we have a policyholder at time 0 who is 50-year-old, then we'll have a policyholder who is 50 plus t years old at time t. The remaining duration of the contract is 20 minus t. So this is the EPV at time t of the future benefits on the contract. And we need to subtract at time t the value of the future premiums to be paid on this particular contract. Yeah, so that's how you can see it. You've got at time t the EPV of future benefits minus the EPV of future premiums. And that's the amount of money that you will need to hold, that you will have to hold, at least in terms of expected values. This is the expected amount of capital that you need in order to be able to fulfill your liabilities towards your clients, right? Now, with an endowment, this is a little bit peculiar. So we could say that this expression holds for t is 0, 1, up to, etc., time point 19. And do take into account, and this is also related to the computer lab that you're currently working on, but for an endowment insurance in particular, if you look at the policy value right before time t, that should be equal to the sum insured, which is in this case 500,000 euro. And then the policy value at time 20 itself, which is the end of the contract, that will be 0, right? So right before the end of the contract, the policy value will correspond to the pure endowment, to the sum insured as a pure endowment in this contract, which is in this example, the 500,000 euro. And then at time 20 itself, so the end of the contract here, the policy value drops to 0. Okay, now what we're going to do is we're going to massage this expression such that we will be able to come up with a recursive relation for the policy value at time t. And that will be a very practical approach in exercises where, for example, the death benefit throughout the contract is a function of the policy value in this contract. So these recursions will help you to solve, let's say, a bit more complex exercises. So what are we going to do? We're going to focus on these two expressions that you see over here. And we're going to rely on the recursive relations that we already derived earlier on in the course for these EPVs, plug them into this expression for the policy value, and deduce a recursion for the policy value as such. Yeah. So what are we going to use? So we use the so-called splitting identities, if you want. So if we look at the EPV of an endowment insurance issued to a 50 plus t-year-old with a remaining duration of 20 minus t years, then we can say, okay, let's make a difference between the first year in this contract, so what's going to happen between time 0 and time 1 in this contract, and then the remaining years in this contract. So this is my splitting identity applied to my endowment insurance. Yeah, the endowment insurance is now issued to a 50 plus T-year-old. The remaining duration is 20 minus T. This is the EPV of the benefits that are guaranteed in the first year of this contract. And here we've got then the EPV of the benefits, which are guaranteed from the second year in the contract on, right? So this is what is happening between time 0 and time 1. And here we've got what is happening between time 1, let's say, and the end year of the contract, which is in this case time 20. Okay, that's a splitting identity that we've already seen. And we can do something similar for the EPV of our life annuity, which in this case is taking care of the premium payments in my contract. So here I'm going to do something similar, what is happening in the first year and what is happening from time 1 on. So that's again my splitting identity. So this is what is happening in the first year, and this is happening in later years. And we value all these life annuity payments. We value them at time 0, of course, right? So this is the splitting identity as we've been using it before. So what we now want to do is we want to plug these expressions into the more general expression, or the general expression that we have for our policy value over here. So we're going to plug it in and we're going to see what kind of recursion we're then able to deduce. So that gives me that the TV is the sum insured, in this case the 500,000 euro, times V times Q50 plus T, plus V times P50 plus T. And then you've got the EPV of an endowment issued to a 50 plus T plus 1-year-old with a remaining duration of 19 minus T years. And for the premiums, we do something similar. So we're going to rely on the splitting identity that we just derived for the EPV of a life annuity, and we'll retrieve an expression like this. Right, so this is just a matter of plugging in the EPV for the pure endowment and the EPV for our life annuity, right? So if I put some terms together, I'll get the following expression. So I can put the V in front here. I've got 500,000 times Q50 plus T plus P50 plus T times the 500,000 like this. Minus P. So what I did here is I looked at the part that you see over here, and I combined it with the P multiplied with V multiplied with the survival probability and this guy. And then I rearranged the expression like this, right? So why do I do that? Because now I can immediately see that if you look at this guy minus this guy, that this is exactly the policy value in this endowment insurance policy. This is the policy value at time T plus 1, because now you see that we're working with age 50 plus T plus 1. We've got a remaining duration of 19 minus T. And here as well, we've got 50 plus, this should be a plus 1, of course, 50 plus T plus 1. And we've got, again, a remaining duration of 19 minus T. So putting it all together, I derived the following recursion. I've got V multiplied with 500,000 times Q50 plus T. I've got plus the survival probability times T plus 1V minus P. And this is the expression, this is the recursion that I retrieve at this point for my policy value at time T. Now, if I do some very last steps, I can see that this brings me to TV plus P multiplied with 1 plus the interest rate is equal to 500,000 times Q50 plus T plus P50 plus T times T plus 1V, right? So this is the recursion that I wanted to obtain for this particular setting, where I've got an interest rate I that is constant throughout the duration of the contract. I've got a sum insured, so the death benefit is 500,000 euros, the pure endowment is 500,000 euros. I've got a certain assumption about the mortality rates. So that gives me, in this particular case, the following recursive expression for my policy value. Okay, so of course, when you work with a recursion, you'll need a starting point for your recursion. So in this case, we could start, for example, with the policy value at time 0, which is 0, or we could work with the policy value at the end of the contract, which we can plug in here to retrieve then the policy values at earlier points in time. So that's what we're going to illustrate in some of the exercises that are coming up in the sheets, right? So this is what we did. We started with our policy value expression at time t. Then we used the splitting identities for the EPVs of our endowment insurance and the EPV of a life annuity. We plugged that in, we rewrote the expression and came up with, for this example, a particular recursive expression for our policy values. So what I'm going to do now is I'm going to return to the sheets and I'm going to derive this similar recursive relation, but I'm now going to do that in general, in a more general setting. So not for the particular product that we've been working with on the iPad, but for a more general case. Yeah. So here you see on sheet 34, that is the recursive expression that we just derived. So how can we now generalize this to a strategy that is workable, that is applicable to any type of life insurance product that we want to consider? So here is the strategy that we followed. We started from an expression for TV. We broke up this expression and the EPVs in this expression using what's happening in the first year. So the first year after time t. So that means between time t and t plus 1. And what is happening in terms of EPVs, what is happening from time t plus 1 on. So that's exactly what we did. We took the EPVs in the expression for the policy value at time t. We used the splitting identity by making a split between what's going on in the first year and what's going on afterwards, right? So that's something you can do in a very general setting, which leads us then to recursive expression. So in order to do so, we're going to consider a policy that is issued to an X-year-old, and we're going to focus on the year t plus 1. So that means we're going to focus on what's happening between time t and time t plus 1. So that means we've got a premium, let's call it PT, a premium that is payable at time t. We've got premium-related expenses, let's call them small et, which are also payable at time t. We've got a sum insured, denoted here with capital S t plus 1. This is the sum insured in case death happens between time t and t plus 1. So this sum, this capital, is payable at time t plus 1. And we've got the corresponding expenses. So these are expenses related to the occurrence of death, related to the payment of the insured capital in case of death of my policyholder, right? And then finally, I've got my policy values at time t and t plus 1. So now I want to write down a more general expression on how to go from the policy value at time t to the policy value at time t plus 1. So do note that I distinguish between two types of expenses, premium-related expenses. So they will come with the payment of the premiums at time t. And I have expenses which are related to paying out the insured capital, right? So that's the expense here, capital ET plus 1, which will be payable at time t plus 1 if our insurance company has to pay out the sum insured at time t plus 1. So what are we now going to do? We're going to reflect upon an active policy at time t and an active policy at time t plus 1. So we know that the future loss random variable at time t plus 1, that is the variable LT, right? That's something we discussed in the lecture on Monday. So if we look at what is happening in the year t plus 1, so what is happening between time t and t plus 1, then there are two scenarios that can unfold over time. Namely, either my policyholder survives until time t plus 1, or my policyholder dies at between time t and t plus 1, right? So let us start with the scenario where the policyholder dies between time t and t plus 1. Then how can we see our future loss random variable, right? So what amount do we need in that particular case? Well, in case my policyholder dies between time t and t plus 1, what I will have to pay at time t plus 1 is my sum insured plus my expense that comes with the payout of the sum insured, right? So I need to pay this amount at time t plus 1. So the value of this amount at time t, that I can obtain by applying a 1-year discount factor, here denoted with 1 plus it to the power minus 1. Yeah. So I somehow work with a very general notation here, in the sense that the interest rate can change over time, right? If the interest rate is constant, this would just be an I, right? So this is the amount of capital that I need at time t. But of course, at time t, I will also receive my premium, PT, and I will have to pay the premium-related expenses at time t, that's the small et, right? So an expression for my future loss random variable at time t is given as such. And this is what I need in case my policyholder dies between time t and t plus 1. And that happens if the future random lifetime, the current future random lifetime of my policyholder, hx plus t, if that guy is equal to 0, right? That means that my policyholder dies before reaching hx plus t plus 1. Now, in case the policyholder survives, what do I need then? Well, then I will need the LT plus 1 at time t plus 1, right? So discounting this random variable over a 1-year period of time would be that could be done with the following expression. But once again, at time t, I will receive a premium PT, and I will have to pay the premium-related expense, the small et. So this is the expression. This is a valid expression for my random variable LT in case my policyholder survives, right? This gives me the connection between the LT and the LT plus 1. So what we're going to do now is, starting from this expression, and take the expected value, right? Because the expected value of LT, that's exactly what we called the policy value at time t. So if we do take the expected value, then we can say, yeah, there are two scenarios. There is either this result for LT, which happens in case my policyholder dies, and that's going to happen with a probability qx plus t, right? So that's why I get, if I calculate the expected value for LT, I get the probability that my policyholder dies at hx plus t multiplied with the expression for LT in that particular scenario. And what else do I get? I get the probability that my policyholder survives, the px plus t, and then I multiply with the expression for the expected value of LT in that case. Yeah, so do note, in the second line, there is the random variable LT plus 1. So I will have to write down the expected value of LT plus 1 over here. And do also note that in both scenarios, I will receive as an insurance company my premium PT, and I will have to pay my premium related expense ET. So that's why we've got this PT minus ET with a minus here in front. We've got that in both lines, so we've got that with probability 1 in this expression. Yeah? If I replace the expected value for LT plus 1, if I replace that with the policy value at T plus 1, then I exactly get my recursive expression, which I've been using in my example in a very specific case. So what you see here is the generalization of what we derived on the iPad, the generalization of this recursive relation for the policy value at time t. So what are we using? We've got the policy value at time t. We've got the premium that is payable at time t, the premium related expense at time t. We've got the interest rate that is applicable, that is valid between time t and t plus 1. We've got the 1-year mortality rate at time t, the sum insured, the expense that comes with the sum insured in case it's going to be paid at time t plus 1. We've got the 1-year survival probability, and we've got the policy value at time t plus 1. So this recursive relation, I call it a VIE. It's a very important equation in the sense that in many exercises where you're asked to calculate a policy value, it's good to keep this relation in mind, in the sense that this is often going to help you to come up with your with solving an exercise related to a policy value. All right, so that being said, let us try to give some intuition to this recursive expression. So if we keep it in this particular form, what we can then say is that if we look at the left-hand side, let's start from there, we know that the TV, the policy value at time t, that's the amount of capital, or these are the assets that our insurance company is holding at time t for an active policy, for a policy that is still ongoing at time t. So at time t, next to the assets that the insurance company is already holding at that time, our insurance company will receive a net cash flow income that is equal to the premium minus the expense, right? That's the cash flow that is coming in at time t. So we add that to the assets that we're already holding at time t. And what we're then going to do at the left-hand side of this equation is we're going to roll up these assets until the end of the year. So we're going to see how does this capital grow from time t to time t plus 1. And if we are assuming an interest rate equal to IT between time t and t plus 1, then we get exactly the expression over here as the amount of capital that we're holding for an active policy at time t. This is the amount of capital that we will obtain at the end of year t plus 1, right? And now we're going to compare the left-hand side with the expression on the right-hand side. So the left-hand side tells us this is the cash flow that we have at time t plus 1. If you look at the right-hand side, now we're going to say with a probability px plus t, our policyholder will be alive at time t plus 1. And if the policyholder is alive at time t plus 1, we'll need to hold the policy value t plus 1v for this policy, because the policy is still active, is still ongoing at time t plus 1. So you need to book a capital for that. You'll need to book the policy value for this surviving policyholder. But on the other hand, if the policyholder dies between time t and t plus 1, and it happens with a probability of qx plus t, then what we need as an insurer is we need the capital, sum insured, the st plus 1, plus the expenses that we need to pay out this death benefit. So we'll need this capital at t plus 1, right? So if we compare the right-hand side, that is what we expect to need at t plus 1. In both scenarios, or taking into account both scenarios that can happen, either death of the policyholder or surviving of my policyholder. So this is what we expect to need at t+1. And the left-hand side, that's exactly the amount that we will have given our assumptions if the reality unfolds over time in the way that we assumed it. Yeah? So both are equal if the reality unfolds as we assumed in the policy value basis. So if everything happens as assumed in the policy basis, then what we have at time t+1 will be exactly sufficient to cover what we expect to need at time t+1. And that's exactly what this expression is telling us. Okay, so we look at the capital we're holding at time t for an active policy. We add the premium, we subtract the premium-related expense, and we say, okay, that's the amount we actually have at time t. We let it grow until time t+1. That gives us the left-hand side of this equation. And then we say, yeah, if everything works as according to the assumptions that we made in our policy value basis, then the capital that we hold at time t+1 will be exactly equal to what we expect to need at time t+1. And what you expect to need, that depends on, does my policyholder survive or does my policyholder die throughout the year t+1? Okay, so that's the first intuition that you can give for this recursive expression. You can also do something slightly different, and that's what I have on the next sheet. And what I'm doing now is I'm slightly rewriting the expression at the right-hand side of my equation. Yeah, so I'm slightly rewriting that one, where I say, so here I had px plus t multiplied with t+1 v, right? So you can say, well, this px plus t, that is 1 minus qx plus t. And if you do that, then you can rewrite the right-hand side of this equation like this. So what is now the intuition? Well, now we're going to assume that for each policyholder, whether he's alive or not at time t+1, for everybody, we have an amount t+1 v, right? So the t+1 v at the right-hand side does now not come with a probability. So we assume that for everybody in force at time t, we're going to hold t+1 v at time t+1. But in case my policyholder dies between time t and t+1, I'll need to hold an extra capital, or I need to have an extra capital, and that's the difference between the capital t+1 v, which I assume to be there for everybody, and the sum insured plus the expense that comes with paying out this sum insured, right? So the reason, or the reasoning that you build up here is you say at the right-hand side of my equation, the amount of capital that I expect to need at time t+1, I can say, well, for everybody there is t+1 v, and then for those who will die between time t and t+1, I will add the difference between the policy value at time t+1 and the capital that I need to pay out at time t+1 for those policyholders who do not survive until time t+1, right? So that's what I need. That's what I expect to need according to my policy value basis. And again, at the left-hand side, what I get there is the cash that I'm building up from time t to time t+1. So if the reality is unfolding as assumed in my policy value basis, once again, I will have an equality between what I actually have and what I expect to need according to the policy valuation basis. Yeah, I just took a slightly different perspective here in looking at the interpretation of the right-hand side of my equation. And why do I do that? Because this last thing here, this difference, and I should write it with a t+1 because that's the convention in the book. This st+1 minus the tv, that's also sometimes labeled as the sum at risk or the net amount at risk in life insurance literature. or people sometimes also call that the debt strain at risk. So it's the difference between the, the notation is correct, but I had it here in my expression, I had it here for time t plus 1, and here I just used the notation for time t. Yeah? So the difference between the sum insured and the policy value at time t, that's what we call in the literature the net amount at risk. Yeah? So that's required to increase the policy value in case of death of my policyholder. Any questions on this? So this gives me an interpretation for the recursive relation. And that's something I want you to be aware of, because these recursions, we can often use them in practical settings, in exercises, etc. So what I want to do is conclude this particular subsection with doing one exercise from the book where you see these recursions being used. Okay, and that's exercise 7.7. So what we have here is a 20-year endowment policy issued to a 50-year-old. We've got level premiums of 23,500 euros per year, payable annually throughout the term of the contract. We've got a sum insured of 700,000 euro, payable at the end of the term. And on death before age 70, a sum insured is payable at the end of the year of death, which is equal to the policy value at the start of the year in which the policyholder dies. So this is a particular endowment contract where the pure endowment is 700,000 euros, but the death benefit for death throughout the contract, that's going to be the policy value at the start of the contract, at the start of the year, right? So that's a little bit peculiar, but you can see the intuition. You can see this policy value as a sort of assets that you're building up by paying premiums throughout the duration of the policy. So in this case, the contract is designed such that the capital that you build up will be paid back to your beneficiaries in case you die before the end of the contract. That's the intuition here. Yeah. So we've got certain assumptions about interest rate, etc. And we now want to find a practical way to calculate the policy values on this contract. And immediately you can feel that that's not going to be so easy if you take the traditional way to write down this policy value prospectively or retrospectively, because the death benefit here is connected to the policy value, right? So this is an example where the use of these recursions will then come in handy, will give us a practical way to come up with the policy values. So let's see how that goes. Well, in a general setting, we derived the following expression, right? So that's the recursive expression as we just derived it. And of course, now we have to translate this general setting to our concrete example. And our concrete example is that we do not have any expenses. These are not mentioned in the exercise. So we leave out the expenses. So the E, the small e, the capital E are both 0. We've got an interest rate of 3.5%. And we've got certain sum insured, we've got policy values. So without further ado, we say, okay, we have to look at this particular recursion and we have to think carefully about the sum insured, the ST plus 1. We have to think carefully about my policy values at the contract boundaries, okay? So this is a general expression that I'm starting with. And what I can do now is what is happening in the final year. So the final year, that means between time t is 19 and t is 20. So I can say the death benefit at the end of the year is 19V. So if my policyholder dies in this final year, what my beneficiaries will receive is the policy value at the start of the year. So that's the policy value at time 19, so that's 19V, right? But if my policyholder survives until time 20, then I have to pay out the sum insured, the pure endowment, which is 700,000 euros in this case. So if I write down my recursion on the previous sheet, if I write that down explicitly for the final year, I'll get something like this. So I've got 19V plus P multiplied with 1 plus my interest rate. And that should be equal to, in case I die, I need to pay back, or I need to pay to my beneficiaries the 19V. If I survive, I need to pay the 700,000 euros.